Hi guys, and welcome to Loan Market News. This week we're going to update you on a few items of policy that have changed in recent weeks with our lenders, which could improve your potential for borrowing more money, or actually borrowing at all from the banks. So the first item I want to cover up on is we are now in October, so happy October. And what this means is that in the past 3 months, lenders have been using your PAYG statements to calculate your borrowing capacity, which in a lot of cases, if you're earning less last year than you're earning this year, has reduced your borrowing capacity with those lenders. The good news is now we're in October and they can use 3 months year to date for the financial year, that's June, September, we can start using your recent pay slips, which in a lot of cases will improve your borrowing capacity and your chance of borrowing with that lender. So if you've experienced any problems in recent times with funding, now's the time to recall us, have a chat and see if we can get you the borrowing you wanted. And also, Andre, what else we got?
There's so much happening with the buffer rates. But first of all, what are the buffer rates? Basically speaking, when lender is assessing your deal for serviceability, they add about 3% on top of the actual rate you're getting, just to make sure you can still afford your mortgage in case of further rate rises. Well, number of lenders have started reducing their serviceability buffers, and there's more and more lenders that joining the panel. Basically, if you are refinancing your mortgage, now there is a number of lenders that will only use 1% serviceability buffer on top of the advertised rate, which will absolutely improve your borrowing capacity. So let's say you weren't able to refinance 6 months ago, now it's the time to review with more lenders on a lending panel that have 1% serviceability buffer. You have higher chances of getting a better deal for yourself. On top of that, number of lenders have implemented reduced serviceability buffers for purchases as well. So those are around 2% and more lenders joining in. And if you thought that was everything, there's more. We have lenders who have now extended maximum loan terms up to 35 and 40 years, which can dramatically improve your borrowing capacity. So if you haven't sat down with a broker for about 6 months, this is the time. There's more and more news in the marketplace. It's a good opportunity to review your position.
Well, I'm genuinely excited by all that. Another quick point to bring up quickly, I was looking at my emails as I came to sit down for this news desk item, and currently 1 in 3 loans being written are for the First Home Lenders Deposit Scheme. Now, for those who need a refresher, that's the scheme where you can buy a property at 95% and the government guarantee your LMI, Lender's Mortgage Insurance. Good way of getting into property if you haven't got a big deposit. And the point of this exercise is, if you're thinking of buying via that scheme, talk to us. There's only 40,000 places across the country and they are going fast. This is the year for that scheme. So if you're interested in the scheme, if you're interested in knowing your borrowing capacity for a refinance, or just generally want to look at a new purchase, obvious team to talk to, Andre and myself, details in this email in this video. We'll speak to you soon. Thank you.
Thanks, guys.